Hey, good afternoon. How's everybody?
I'm good, Professor.
Good
Good.
afternoon,
How are you,
Professor.
Dexton? How are you,
Good
Eva?
afternoon.
Okay.
Good afternoon, Mamadou. Okay, I see four people here, uh, and that's, I believe, exactly the number of students I saw in today's forum, right? Before I came to, I have five people in today's forum, so one more person, one, two, three, one more person still needs to join. And yes, the fifth person has joined. Okay, Peter has joined. Okay, so I have matching number of people in um, both apps or both. What should I say? Both um, rooms, right? Um, so the quiz one is over, right? And I'm going to post the summary stat today. Um, and we are actually, as of today, we are actually in the topic. Uh, we have been into topic three already since last week, I believe, at least last week. And today, I believe these two uh, videos are today's lectures. And actually, single cash flow model, compounding. It's all about compounding and discounting. This is something we already talked about um, a lot at the beginning, in with the first topic, right? So we won't take, we're not gonna spend too much time on these two single cash flow models uh, but we still need to wrap up before that. We still need to wrap up the financial statements. So I believe uh, uh, we wrapped up everything about the income statement in the last class, right? We talked about EBIT, uh, which is earnings before interest and taxes, right? And then which is also called operating profit, as well as operating income. And then from next, because EBIT means earnings before interest and taxes, it's already self-predicting, right? It's almost like a self-fulfilling prophecy from here, because think about it. It's earnings before paying interest and taxes. So what should come next? What should happen next is paying interest. And I told you we pay interest because we have debt, and the debt is inevitable, which will appear in the balance sheet. Debt is inevitable because debt is a source of capital, and we need debt um, uh, because when we started our business, right? When we started our business, we need uh, plant and equipment, building and land, right? For any manufacturing business, right? Plant and equipment is crucial, right? So we got that, and that's it's because of interest is for the debt we have. So this is the interest we have to pay. If it is interest income we receive, it won't be recorded here. It will be recorded here as part of the investment income, right? But this is the interest arising from the debt we have. So after paying out interest, then I should drop out. right? From EBIT, I must drop out. And then it becomes EBT, earnings before taxes. And another name for that is taxable income, right? And in our case, we already had negative EBIT. So our EBT will be more negative because we have interest to pay. But then, taxes will have to be zero. In other words, I used, some people think, they will just, oh, this is taxable income, so I multiply tax rate to that, multiply tax rate, this tax rate, and this must be my taxes. But I've been saying this over and over. This is a senseless. This is a nonsense. Why? It's clearly not. Because you pay taxes when you have taxable income or taxable, earnings, EBT. But if your EBT is zero or negative, then you don't pay taxes, right? You cannot just do it mechanically and, say, this is our taxes. Look, there is no such thing as negative tax, right? Negative tax is like the government paying you, the IRS paying you taxes. There is reverse tax, such as child tax care, credit or something like. I don't know if it is called child tax credit or not credit, but actually, like you get money from the government. I mean, if you are on the poverty line, or there is that's called there is some payment coming from the government. That's called reverse tax. Reverse tax means redistribution of taxes, right? Or transfer payment. It's called reverse tax or transfer payment, meaning what they raised, from in taxes from the wealthy, it gets redistributed to the poor. But that idea, a lot of controversy around that. But anyway, the point is there's no negative tax. There can be if you don't have your business has incurred loss, and then there should be no taxes. So if you just mechanically, this is just doing it mindlessly, just mechanically and without any, mindfulness, right? The mindfulness is very important because you do just, mindlessly, and then come to this result. Well, what did I do wrong? you did the math, but you just didn't use your good sense, because obviously you cannot have negative tax, right? So to prevent that, sometimes people do things, mindlessly. To prevent that, I use, this if command. If command is, this is not the first time you, maybe this is the first time you saw this. But, it's a very simple command, but it can have, it can be so useful. It comes in handy under so many circumstances. So I use this if command. If J28, which is the taxable income, is positive, right? Positive, greater than 0. Then this first comma means then. Then, of course, we will multiply tax rate to our taxable income. A second comma means otherwise, right? Otherwise, then 0. In other words, if this is negative, this won't be executed because it's not this case, right? This won't be executed, but this will be executed, right? Zero will be put there. So Excel automatically makes that decision, puts zero there, right? This way you can avoid mindlessly, putting negative tax, right? And then finally, so our net profit or net income. I explained why it is also called income here. I told you I personally don't like income after this stage. This is gross income, but after gross income, right? You can't have uh, repeating. Keep calling. If you keep calling that income, this is net already in net stage. In net stage, if you keep calling it net income, if you keep calling it income, that's kind of weird. But again, because of personal, this income statement is what the businesses keep. So for businesses, profit is a better word here. Otherwise, EBIT, right, and EBT. Um, so earnings is the same thing as profit. Earnings is the same thing as profit, but income is not the same thing as earnings. Clearly, right? Income is not the same thing as profit. But why do they keep, that's the accounting's practice, right? In accounting, they keep calling this operating income and net income. And I'm not comfortable with that. But if this is not a business, but a person, right? A personal income statement. And again, personal individuals don't have to keep income statement. Of course, there's no law against it, but it's just not used for any tax purpose. A business's income statement is, used for as the source for, their tax justification. In case of, individuals, it will help. I mean, you can keep your individual personal income statement there, but then it serves no tax purpose, right? I mean, you can calculate your taxes based on this, your, taxable income, but then for personal income tax, you will have to go through, there are deductions and exemptions, deductions and exemptions. So you can, you will need to, it cannot be, straightforward from this. But anyway, if you are keeping personal income statement, then calling this operating income or operating income, that's still weird for a person. But pretty much you can, after paying taxes, you can call that net income. It's better to call it net income rather than net profit, because it's personal case. But for business, it's a better term to call it net profit, and that pi stands for profit, right? Or it's called EAT, earnings after taxes. Now, think about it. You may remember pi as the symbol for inflation, right? Yes, pi is the symbol for inflation in macroeconomics context, but in microeconomics context, pi is the symbol for profit. Okay, so depending on the context, the symbols have different meanings, right? Of course, CA would stand for, current assets in our, in financial accounting's context, right? CA, current assets. But in postal service, CA would mean California. So of course, all you understand, all acronyms and symbols uh, mean different things depending on the context, right? A mail sorter would never, read CA as current assets, right? So net income or net profit, better word is net profit. Net profit will be operating profit minus, right, interest and taxes. So from J25, I subtract sum of these two line items, right? J27, J29. Of course, there will be no difference. I mean, it will still be the same thing. Uh, but this is how you arrive at the net profit. Now, so that wraps up everything about the income statement. So we need to move on to the balance sheet. And I told you at the beginning of this topic, income statement and balance sheet serve two different purposes. They all serve different purposes. First of all, income statement is about uh, explaining or describing the process leading to profit, right? Profit or loss. And then it's a description of operating activity, right? I told you all businesses are engaged in three activities. One is operating activity. Second, investing activity. Third, financing activity. Now, operating activity is basically, starting from sales revenue from here to here, arriving at operating profit, right? I mean, that's what the business operation for businesses mean. They have to sell something and they have to subtract the expenses and arrive at operating profit, right? That's what the businesses do. That's their operation. So, um, income statement is basically the history of operating activity. And then the other two activities, investing activity and financing activity, are all described in the balance sheet. Now, the balance sheet, I put it side by side, but most of the times they stack it up. Most of the times, in other words, liabilities and equity part comes at the bottom, right? It comes at the bottom of this. I told you the purpose of the balance sheet is describing capital structure. And some people might say, if you have taken, accounting already, it might say, oh, isn't it about, showing, assets and liabilities, and equity? Yeah, that's true. But then think about it. Assets didn't exist without debt and equity, right? Assets didn't exist before debt and equity. What that means is, assets are results, right? Debt and equity are the causes, right? In other words, debt and equity are sources of capital, and then assets are the result of using that capital, right? So let's think about, and the capital structure is basically, what does that mean? Capital structure means what percentage or how much of the total assets came from equity and how much of that came from debt. So it's basically the composition of our assets, composition in terms of debt and equity. In other words, composition of source of capital, right? Uh, so in our example, the composition is like 60% debt and 40% equity, which is pretty much heavily skewed to debt, and which is a recipe for disaster then, right? Normally you would want like the optimal capital structure would be found somewhere between 70% equity, 30% debt, and 60% equity and 40% debt. I mean, somewhere between that kind of capital structure, you would find optimal capital structure. Now, and I'm telling you that from my empirically from my own um, from my own and it's not just from my own research, but it's pretty well established fact. Now, so think about it. As I said, sources of capital comes before the uses of capital, right? You have to raise capital first. So first thing, suppose you are a startup, right? A computer manufacturer like Dell. And if you think about it, all manufacturing, right? All manufacturing businesses must have plant and equipment, right? Building and land. I mean, that's very crucial to. It's very crucial to manufacturing, plant and equipment. I mean, building and land. Retail businesses can have building and land. They can have their own building, standing up on their own turf, their own land. But retails don't have plant and equipment. The biggest difference between manufacturing and retail is the plant and equipment. Only manufacturings have plant and equipment. And if you are in computer manufacturing, right, plant and equipment must be state of the art, right? It would cost at least hundreds of millions of dollars to build. But let's say you are a startup and you need plant and equipment, building and land, which are called fixed assets or physical assets or real assets or long-term assets. I mean, just for that you need $10 million. Just for that. How would you raise $10 million? How would you raise $10 million? Now, the obvious answer is go get a loan from the bank. But the problem is you are just a startup and you don't have any track record. You don't have anything to put up as collateral. What kind of bank will make you a loan? It's realistically, the probability is zero, right? But back in like 1976, Bill Gates built his, they manually built the PCs, in 1976 in their father's garage. Bill Gates and Steve Jobs, they all manually built their first computers in their father's garage, right? But then at the time they were startups, and then they had no capital, right? They couldn't raise any capital. Because, as I said, there's no They don't have track record, nothing to put up as collateral. But as their business grew, they needed, they cannot build it by hand anymore. They have to do, they have to have mass production facility. So then they need an investor. They cannot get a loan from the bank. They'll have to get an, and who's going to invest in a startup? Startups don't have uh, uh, track record to really, brag about, right? Um, and they are just big question marks, right? And then comes the, so what do these startups do generally? To raise capital, they will have to find investors. So what do? They usually, they go to a convention or trade fair, right? And at the trade fair and conventions, in their booth, they demonstrate their prototype and they demonstrate their uh, product and their technology. And then if any investor, I mean, in those conventions, uh, there will come those, venture capitals, right? Or angel investors, right? Venture capitals, they find them at conventions. And then if they find this, venture capitals are literally, they are taking a huge risk. They are on an out, they're on an adventure. So literally, so if they find this new technology, this product, new, technological gadget, to have huge potential, then they will invest. That's usually, how it starts. Michael Dell started out a little, obviously, is, not the same generation as Bill Gates and Steve Jobs, but, Michael Dell started also from his, I don't know, from his father's garage or friend's garage, or basement, started to build by hand, and then, then took off like that, Um, so um, basically, in reality, the realistic scenario is that it's that hard to get investors, but because we are doing a thought experiment, and for the sake of our thought experiment, let's say we found an investor, so we got $4 million invested. Of course, this $4 million is equity, meaning the venture capital is uh, partaking in this business as the major shareholder. I mean, this 4 million came all from them, so they are practically the owner, right? The venture capital is the owner of this company, and of course, as the founding member, you may have some shares uh, issued to yourself because you only have to print it. Give venture capital, like 4 million shares, right? Let's say, it's $1 per share. And you can keep yourself, like 1 million shares or whatever, because you are the print founding member. You can just print. Uh, uh, but actually, then the equity is diluted. I mean, if there are 5 million shares and $4 million, then each share is not even $1, right? It's going to be like 80 cents then. But anyway, you have the investor, and then you are able to get a loan from the bank. So hypothetically, everything was, we got the loan from the bank, and you were able to sell bonds. First of all, this is impossible. This is unrealistic, totally. It's just our hypothetical example. Why? Because first of all, you are not listed in the stock market. You're a startup. Startups cannot be listed. They don't meet the basic requirement, right? Uh, So you're not listed in the stock market. And if you're not listed in the stock market, you cannot sell stocks in the stock exchange, any registered stock exchange, or neither bonds. You cannot sell bonds either. Um, so this is only a hypothetical case for our thought experiment. But so let's say you could get a loan and sell bonds. So these are basically long-term debt. Non-current liabilities are long-term debts. And this 3.5 million, which is mortgage loan, we can pretty much, um, we can pretty much tell where this 3.5 million go. It went into building and land, right? 3.5 million, right? It went to building and land. That's why it was mortgage loan, because it's building. And then the plant and equipment was 6 million. Of course, that's 6 million. At least 4 million of that must have come from equity, right? So, and then the other 2 million must have come from bonds payable. No matter what, this explains what the long-term debt and long-term assets are about. Long-term asset means, physical assets or real assets or fixed assets, right? They go by different other names. But one thing is for sure, the if you are a manufacturing, right, your long-term assets are pretty much, plant and equipment, right? So that brings us to the this definition, right? For assets came from liabilities and debt, right? Assets came from liabilities and debt. That's why this side represents the source of capital, source, right? And there are only two sources of capital, either equity or debt. And the asset side is the use of capital, how that capital raised through equity and debt, how that capital is used, and in what form it is held, right? What form it is held in, right? That's the asset side. And again, of course, in accounting, assets are defined as equal to liabilities and equity. I mean, that's called, accounting equation. Assets are equal to liabilities and equity. That's why it's called balance sheet. They must balance out, right? Both sides must exactly balance out. They must be equal, right? Otherwise, think about it. If this side, source of capital, this side is greater than the asset side, then what does that mean? As something is missing in asset side, right? If you raise 10 million, right? If you raise 10 million through debt and equity, right? The assets must be equal to 10 million as well. I mean, at the same time, I mean, over time, they will deviate, but then at the end, when you reconcile the book, then the numbers must match, right? That's why it's called balance sheet. It must balance out. But let's say at the same time, at the same at the beginning, like time zero, if they don't match, what does that mean? Somebody took that money. The difference means the money is vanished somewhere, could have been embezzled, or somebody's, it could have been embezzled, or it could have been simply lost. Either case, this is a serious crime, right? If somebody embezzled, or if the money is lost, the capital is lost, it cannot be lost, right? But if there's a discrepancy, the only two explanations is somebody embezzled it, or it just vanished, right? There must be a good explanation for that discrepancy, right? Because it's balance sheet, it must be balanced out. Now, also in terms of about the definition of assets, right? Yeah, mathematically, assets are defined as liabilities plus equity, right? But the verbal definition of asset is something that generates income, right? An asset is something that has income generating power, right? That's an asset. If it cannot, if you have an empty lot, right? Like 100 square feet, 100 square feet of empty lot in Midtown Manhattan. And what's 100 square feet? It's 10 feet by 10 feet, right? 10 feet by 10 feet. That's, so it's a very small space, actually. 100 square feet is a very small space, isn't it right? It's just 10 feet by 10 feet. But if you have, you might say, if you have 10 square feet in Midtown Manhattan, oh, that must be, must have great, it must be a huge, great asset value. Well, if it is generating income, it has a great asset value. If it doesn't generate any income, then it doesn't have any asset value. It has, it's a non-performing asset. So think about it. Nobody will just idle. If you have 100 square feet of empty lot in Midtown Manhattan, nobody will just idle it. Isn't that right? In that 10 feet by 10 feet, you can at least park cars. Well, it's just 10 feet by 10 feet. How many cars can you fit into that? Maybe, 3 minis, right? You can probably park 3 minis in, 10 by 10. Once you start parking cars, then it generates income. Isn't that right? And then it is an asset. And then if you build a parking structure there, parking structure is relatively easier to build than a building, right? A full-scale building. And the parking structure is, 20 stories high, right? Of course, there will be a parking elevator and things like. Flat 100 square feet, you can park 3 minis, but if it is 20 stories high, 3 times, you can park at least 60 minis or a lot of, cars, and it really has a, income generating power. It's a, lucrative asset, right? It's an asset. However, now, so asset must have income generating power, right? The thing is, then when we call asset sounds like then, look, you raised capital. Isn't that right? You raised capital through debt and equity, right? But the term, it sounds like asset is pretty much the same thing as capital. Because capital is the definition of capital, if you remember, the definition of capital is uh, uh, means of production, right? Something that serves to make something, means of production. So just like that, uh, means of production will produce output, right? Output. Output sold, if output is sold, right? Um, that's revenue, right? If when the output is sold, that's revenue. In other words, or income. Income is the monetary side of the output. Isn't that right? Income is the monetary side of the output. Dollar value put on the output. An asset, think about it. Asset has income generating capability. Income is the monetary side of the output. Income is, output with the dollar value on it. So it sounds like a asset is, means of production, right? Sounds like asset is like capital. Yes, they mean pretty much the same thing, but then the difference is asset is, asset is the monetary. When we say asset, um, it is focused more on the monetary side, right? Asset value. I mean, the value of the asset is what, present value of all the income, future income it can generate. Um, but when we say capital, right? Capital in this case is money capital. You raised money capital, right? This $10 million money capital you raised, but 10 million, part of the 10 million is current liabilities. Current liabilities are short-term debt, and they are not called capital. Short-term debt is not called capital. Capital is only long-term capital, like debt and equity. That's long-term capital. That's capital. Okay, that's capital. And I told you also at the beginning of this semester when we talked about the ROI, I said, long-term financial market is called capital market, and short-term financial market is called money market. So that's the difference, right? Capital and so this is not called capital, but these are called capital, right? And these are physical assets. Physical assets are also called physical capital. Physical assets are literally physical capital because physical capital, that's literally means of production. Physical capital is means of production. Okay, so it's not difficult to understand what is meant by long-term assets or fixed assets, real assets or physical assets, right? Or non-current assets. And it's not difficult to understand what the long-term debt is or non-current liabilities are. But then, let's go into the current assets, okay? The current assets are short-term assets, but more specifically, it's liquid asset, liquid. Okay, short-term, current sounds like short-term. Current is present. Current. The current news, breaking out, news flash, news outbreak. All these things sounds like current, but what it really means is liquid asset, right? The current and current liabilities literally mean short term, but in current assets, the point is they are all liquid assets. Liquid means, and at the beginning of when we talked about the risk premiums of the bond, right, in the previous semester, the previous topic, Liquidity means, how easily you can convert any asset into cash, right? Cash is the most liquid asset because cash is already cash. And all these assets are listed in the order of liquidity. So if you think about it, and you remember liquidity risk premium, right? If the bonds of less known company, unknown company, um, bonds of the unknown company is hard to sell, hard to liquidate. So there's got to be because it's unknown, little known rather than unknown, little known company. So you have to pay risk premium, right? Which is built into the interest rate, the coupon rate that the bond pays, so that it would be more, marketable. Um, so we know what liquidity is, and cash is the most liquid asset. What are cash equivalents? They are very short-term money market instruments, very short-term money market instruments, right? That are, very safe. And I, in the topic 2 folder, I linked it here. I linked it up. Cash equivalents are short-term return, low risk. Low risk meaning, it doesn't have a risk of losing value. So they don't change in value frequently as stocks. Not only, losing value, there's very low risk of, low default risk. Well, those are cash equivalents, cash equivalents. So if you click on that, it will take you to this page, and you can listen to this short. You can watch this short video.
Cash and cash equivalents are items on a company.
So I'm not gonna dwell too much on that. It takes too much time. And the marketable securities. That means marketable securities means stocks and bonds. And you might wonder, does that mean this bond, this stock? No, not your own. As I told you, this is the source of capital, but this is the use of capital. That means some of your $10 million are held in stocks and bonds of other companies, right? In other words, using that money you invested in stocks and bonds of other companies, right? This is a startup. Obviously, they want to they want to put some of their capital in high return stocks. I mean, stocks that have good return and very safe bonds, right? So that something like Treasury. So that's marketable securities. And promissory notes. What are promissory notes? Promissory notes are one of the payment modalities that they use in B2B, in business to business. Promissory note is an IOU, but a personal IOU cannot be used in business, right? Personal, who's gonna you go to Best Buy or Apple Store, buy an Apple computer, pay with IOU. Will that be accepted? No, it's not acceptable, and it's not even honored because you are an individual. But if you are a business, you can do that. And that's called, a promissory note, literally, promise to pay. Now, promissory notes have maturity theoretically up to 360 days or 359 days. But in reality, most promissory notes, maturity of the most promissory notes are no longer than 60 days on average, right? So suppose, Best Buy went to Dell to buy 1,000 computers. And so Best Buy bought 1,000 of Model X by Dell, Model X. And this Model X is, let's say, $300 per unit. Of course, that's the price per unit. And this is X factory price. In other words, this is the manufacturer's price. Manufacturer's price. And Best Buy is a retailer. So when they sell it, they will mark it up. They won't sell it for 300. They will sell it for probably 400 or 500, right? But that's what the retail is, right? That's what the retail is all about. Now, so they bought 1,000 units of Model X. So then they will have to pay 300 times 1,000, so $300,000. Now, if you think about it, there are four, as I said, four payment modalities, right? The first one is, of course, cash. Second, check. Third, credit card. Fourth, promissory note. Promissory note, right? Now, from the buyer's perspective, promissory note is the most preferred payment modality, right? And from the seller's perspective, promissory note is the least preferred payment modality. From the seller's perspective, cash is always the most preferred payment modality. Why? First of all, think of it from the buyer's perspective. If you think about it from a buyer's perspective, the buyer chooses to pay, always, prefers to pay with promissory note because it can buy them time up to like 60 days on average. Let's say 90 days, up to 90 days. Okay? That means for the next 90 days, the buyer can use this $300,000, right? For whatever purpose they want to use it for. And in this case, let's say having use of that money is having use of that money gives a lot of advantage to the this company. For example, the buyer finds an investment opportunity that can return 10% over just 90 days. Okay? Of course, all the returns, all the rates must be annual, right? I've been telling you from the day one, all the rates are annualized, right? All the rates must be expressed as annual. But in our example, let's just make it simple. Let's say this, 10% is just for 3 months, right? 3 months. If they can make 10% return in 3 months, which is, then $330,000, right? They will have $330,000. They made 10% return. Then they would like to use this, fund, right? They want to keep maintain the use of this, fund, 300K. If they paid cash, then they forego that opportunity, right? They forego the opportunity. If they pay with check, most of the checks will clear within 3 days to 1 week at most, right? And so they cannot use the, they cannot use the fund because it's going to be cleared in 3 days. Now, credit card buys time for only 1 month, right? So that's, credit card buys, up to 1 month. So that's second choice from the buyer's perspective, right? And then promissory note, theoretically, it can go up to, as I said, 1 day less than 1 year, right? But nobody uses, like 359 day promissory note because nobody wants to accept something like that. Nobody wants, right? Cash flow is a very important thing for every business. especially for small businesses, cash flow can kill the company. Uh, right the next day. Today you're fine, but due to cash flow shortage, it can kill this company. Right the next day. And why? Because uh, businesses have a lot of accounts, current liabilities. Businesses have a lot of current liabilities that become due every day, right? Every week, every month, and within 1 year, uh, these payments that become due, right? Payments that come due, um, this happens, almost daily. And if you don't have uh, sufficient current assets to cover it, right, you go bankrupt, right? That's bankruptcy. That's default. Default. You can default, and repeated defaults will lead to and repeated defaults and high amounts to pay. It can lead any business to bankruptcy. So it's that important. And remember, Evergrande. Evergrande is a usually, giant corporations are better with cash flow situation, right? Compared to small businesses, giant corporations are better in cash flow situation. But there's no guarantee. Evergrande is a huge, company, giant corporation in China. But they were almost at the brink of default just a couple of weeks ago. And now they are not out of woods yet. Every day they have, accounts payable coming due, right? Every day. And then every day, they are they make it, by the skin of teeth, right? Barely, it's a narrow escape, day-to-day narrow escape. But even the giant corporations can default, right? Due to uh, lack of liquidity, lack of cash flow. So liquidity means, first of all, yeah, it's defined as it can be defined on three levels. First, how easily you can convert the asset into cash. That's liquid. On the second level, it means cash flow. Liquidity means cash flow. On the third level, or on macroeconomic level, liquidity means money supply, right? When they say liquidity crisis, what does that mean? Money supply crisis. Money supply dried up. Banks are not lending, right? And the economy will run into liquidity crisis. Now, so promissory notes, as I said, buys time. So then buyers prefer to use promissory note. It's the most preferred uh, payment method. But it's the opposite from the seller's perspective, right? From the seller's perspective, uh, they are reluctant to receive promissory note, because if they receive promissory notes, um, think about it. If they receive promissory notes, that means they are foregoing that opportunity to put that money into a lucrative investment opportunity. For example, they receive this $300,000 in cash. Then they can put it in the bank and earn at least, a market interest rate for 3 months. Right? Makes sense? But they are foregoing this opportunity if they don't receive promissory note. Or if they receive cash, they can also put it into this stock that can give them 10% return over just three months. But by not receiving cash, right? By not receiving cash, they have foregone this opportunity, right? So the sellers are reluctant to receive promissory notes, um, but then so to facilitate the acceptance of promissory notes, what the buyers do is, issuer of promissory note. Buyers are the issuer also of the promissory note. What the issuers do is, of course, they will have to pay uh, at least something like market interest rate, average interest rate in the market. So with 10%, let's say not 10%, let's say 3%, 3%, 3% interest, right? I don't know what I did. So the face value of this promissory note is 300,000, right? 3% of that is 9,000. So they will be um, the maturity value of the promissory note will be $309,000, right? The future value or the maturity value of this promissory note, right? Par value will be only 300,000, right? The maturity value will be 309,000. Okay, and that's almost like uh, but now think about it. Even if they have to pay interest, even if they have to pay interest, the buyer will use promissory note because uh, they can make 10% return on this. So that 10% return already pays for that 3% interest. In other words, my promissory note is funding itself, automatically funding itself, right? Um, of course, if only I can put that money into something that earns like 10%, something that earns more than the bank interest rate average. So at least the seller will uh, get something for like 3% interest for accepting. It's better than nothing, and uh, uh, better than losing money from bad investment, right? So the sellers generally accept promissory note, right? That's but then none of the theoretically, so the seller, Dell computer can hold on to it until maturity. They can hold on to it for 90 days, and on day 90, they will present it to the buyer, Best Buy, and collect, right? 30,000 plus interest. I mean, 300,000 plus interest. So 309,000, right? But no company, no company actually holds it to maturity. Why? Because of the liquidity issue, right? Especially small businesses have constantly uh, have a cash flow shortage or liquidity shortage, right? So they are plagued by cash flow shortage, problems, right? That's why there's a short-term money market. So what happens is, um, they don't hold on to it most of the times. The sellers, they don't hold on to it to maturity. They take it to the bank even on the day one. I mean, the maturity on the this promissory note is 90 days, so they can they can take it to the bank at any point, even on day one or day 30, day 60, with like 30 days left, or 60 days left, or 90 days left. You can, or at any point. But most small businesses, most companies, generally take it to the bank on day one, and they negotiate the sale of the promissory notes. And if the bank takes over, if the bank buys the promissory note, then it's like switching the lender, right? So think about it. In most cases, you think when you borrow money from the bank or from any lender, the lender borrower, you are the borrower, and there's the lender, and there's no until you pay it off, it will be the same lender, right? This lender-borrower relationship remains constant. But in B2B and in the financial market, this lender-borrower relationship is not a constant. Lender can change. The buyer who issued the promissory note will remain the same, but the lender can change multiple times, right? So for example, you are Dell. Dell took this $300,000 promissory note, actually $309,000, the full maturity value is. You took it to the bank, right? And if the bank buys it from you, then the lender has changed, right? In other words, it doesn't have to be you presenting that promissory note to Best Buy, right? Any third party who is holding and presenting that promissory note will get the payment, right? But then before that, you got paid by the bank. If you take it to the bank on day one, the bank is, if the bank buys it, they won't pay you full maturity value of $309,000. Why? Because they are then taking over the risk from you. Isn't that right? The risk is from you, transferred from you to them, to the bank, for the next 90 days. And then, of course, in this example, it's Best Buy. Best Buy wouldn't, default that easily. But what if, nobody knows. And especially if this is the issuer of this promissory note is not a well-known company, there's a good chance that this company might default. And if this company defaults, then you won't get your money back. You won't get your $300,000 and $309,000, right? You won't be able to get it back, right? Although this is a I mean, if they default, right? So we have this situation, right? You take the promissory note to the bank will discount it. The bank will discount it because they cannot do it for free, because they are taking over the risk from you, right? So they won't do it for free, so they discount it. And depending on the time to maturity left, right? I mean, the more time left, the more risk the bank is facing, right? So they will discount it more. I mean, simply by more days, right? Even if the discount rate is the same, simply there are more days, it will be discounted more deeply. And with only 10 days left, I mean, if there are only 10 days left, then no one will resell it. In other words, as I said, the lenders can change, because you sell it to the bank. Let's call it Bank A. But the Bank A can sell it to Bank B. Once again, Bank B can sell it to Bank C. I mean, it can go on any number of times before maturity. It can go to Bank C even, right? But then with only about 10 days left, then, nobody's going to sell it because, with transaction cost will be more than, what you can benefit from this. So the point is, this is called also factoring, right? This is called factoring, right? Factoring is originally, selling invoice. Promissory notes are exactly factored or discounted in the same way as, invoices are factored. But this way, most businesses will not run into cash flow liquidity crisis or cash flow crisis, right? And factoring is a very important function in the short-term financial market because most businesses have two types of accounts receivable. One is promissory note, and the other one is invoice. But I put them separately because because promissory note is a kind of accounts receivable, but I wanted to distinguish it from invoices, which would take up the majority of accounts receivable. Okay. All righty. So we're out of time. So we'll have to call it a day here. Any questions so far? Any questions? No? We are down to 7 people.
Thank you, Professor.
All righty. All right. Take care, Peter. Have a great afternoon, everyone. And I will see you guys on Thursday. Okay? All righty. I'll stop
God bless
sharing.
everyone. Have a good night.
All right. All right, everyone. Take care. And I will stop.
Later.
Okie dokie. On Thursday, right? I'll stop recording and sign out.
Professor.
All right.